If you were to look, the first thing you'll see is one of my favorite quotes from Warren Buffett. And it says, if you don't find a way to make money while you sleep, you will work until you die. And that question haunted me for years because it's a great concept, right? Like cash flow, make money in your sleep, but how? How do you really do that? You know, as I had started a construction business, it only made money when I made money, right? When I was out working. And then I started coffee shops. And with the coffee shops, they kind of were passive, but we had 50 part-time employees that were all in their 20s. So we always had people not showing up for work and, you know, quitting on the job. And so thinking that was passive, it really wasn't by the time you figured out that stuff was always breaking. We had locations all over the state. And then I found real estate. And that has been the one thing I have found that you can actually make money while you sleep. So you don't have to work until you die. Like it can be completely hands off. I've got some real estate investments in Florida that I'm not a decision maker in, I'm a fractional owner, and those are mailbox money. And then we have a bunch of properties here locally, same thing. For most of us, real estate is going to be one of the few ways you really can make money in your sleep. Since 1991, in Oregon, real estate values have increased 511%. So you bought a house a few years ago, you probably have equity. If you want to know how much, you can scan that. And we can do what's called like a drive-by CMA or a drive-by BPO, which is a broker's price opinion. And we'll tell you, hey, this is what your home is worth. And if you want to, we'll make a report for you. So then you have home value, what do you owe, and that's your equity. And there's ways to pull the equity out of that house or houses where you don't have to sell it, and then you can use that as a down payment. So that's how people can get into real estate with no money down. You get your first one, goes up in value, you take some money out of it through like a home equity line of credit, and then you've started the cash flow journey into investing. Rates are about 6.5 to 7. Why real estate is so heavily affected by interest rates is it's a 1 to 10 ratio. So if your interest rate went up 1%, that is a 10% increase in your monthly payment. So you imagine most people in here, right? You bought a house a couple years ago, your rate's 2.5%, 3.5%, 4%. So if your payment was $2,000 a month at 3%, it was $2,200 at 4%, $2,420 at 5%, add $242 to that, $2,800 at 6% when rates are at 7%, and that weakens buyer demand. People talked about a real estate market crash. What we've seen so far in this market, we've lost like 5 to 10% of home value since April of 2022, but by no means is that a crash. So because interest rates are high and there's not a lot of buyers, but there's also not a lot of sellers, there's still not much for sale. And as long as there's not that much real estate available for sale, prices can't really go down. You guys have seen like several of the bank failures. So the reason that these banks have failed, take Silicon Valley Bank, they were the worst offender. Most of the banks weren't nearly as risky as they were, but at the end of the day, they bought a ton of bonds. And bonds pay a coupon rate, which is a percentage or a return. So they bought about $16 billion worth of bonds, and they were all average, I don't know, let's say 2.5 to 4% interest. What happens is when you have a bunch of debt at 4% that you purchased, and now the rate's at 6%, you have dropped the value of your 4% money by 30%. Because now, if I'm gonna buy your bond that pays 4%, but I can go on the open market and get 6, I'm going to pay less for your 4, that way I can get a 6%, right? So if it's a $10,000 bond that pays 4%, that's $400 a year, but now I can take the $10,000 and get $600 a year, I'm just gonna pay you less. I may still buy your product, but I'm not gonna pay you 10 grand for it anymore. Maybe I pay you 7. So Silicon Valley Bank has all these bonds, and then people start hearing about they're stuck with all this invested money that's not worth what they paid for it, and there's a run on the bank. Then they were forced to start selling these bonds at a massive loss to cover, and the whole thing collapsed. Google 10-year treasury, 30-year mortgages are tied to the 10-year treasury. So the 10-year treasury, about 3.6% right now, and the average spread for the 10-year treasury is like 2.5% above that. So if the 10 years at 3.5% and you have a 2.5% spread, then you would expect rates to be at 6%. But if you're a bank and you're anticipating rates to go higher, you're gonna have a spread above normal, anticipating rate raises in the future to make sure that you're not caught with too many more lower rate mortgages. Does that make sense? The best interest rates you're gonna get are on owner-occupied properties. So you're gonna wanna pull the money out while you still live there, because the banks know that if you can't make all of your payments, you're going to make your house payment first because that's where you live. So the question was, we own our house outright. We want to buy more real estate. How do we get the equity out of that house to buy more houses? You got two ways to do that. You could do a home equity line of credit. Basically, like some of my HELOCs are a checkbook. Say, you could maybe get a $300,000 checkbook. You don't pay anything in interest. You may pay like an annual fee or an annual maintenance fee, but you pay no money until you use it. So you secure the home equity line of credit now. You pay your, maybe $1,000 in closing costs or whatever the title fees are for it. A lot of these local banks will actually do a HELOC and they won't charge you anything for it. They'll eat the title fees and the title insurance. And then when you find something, then you can write a check out of it. So you always want to make sure that the first thing you do is you get your money figured out before you go start shopping. That way, when the deal does show up, you can act fast. So one is HELOC. That's my favorite kind because it's not costing me any money until I deploy the cash. You always want to make sure you treat debt like a loaded gun. You can go hunt and kill a bear and feed your family with debt, but you also could shoot your foot. So you always want to be careful with debt and make sure that you're disciplined with it. So HELOC's number one. It's my favorite. Number two is you could just take out a cash out refi. You could get a 30-year mortgage, 15-year. They have 40-year mortgages now. Owner occupied. You're going to pull the money out again. Owner occupied financing is the cheapest money you'll ever going to get. And then you'll have the money, but now you're going to be wanting to move the money quickly because now you're making payments on it, right? I don't want to have 400 grand in the bank that I'm paying $4,000 a month for unless I can make that turn into real estate, right? So what would the risks be? Your HELOC's typically gonna go two ways. You can go IO, which is interest only. Most HELOCs, they're gonna adjust quarterly. So like right now, I think one of my HELOCs is at 7%. In 3 months, it could be 6% or it could be 8%. So if you pull the money out on a variable rate, you'll be interest only, so you're not paying it off and your payment will be less, but then you're subject to whatever the market does, so does your payment. The other way is when you deploy the cash, you can usually choose to have your HELOC amortized, where then they lock the rate and they lock the payment over 15 or 30 years. So the real risk with a HELOC would be if you borrow the money and for some reason you can't pay it back. So that's why I always say, if you're gonna do it, buy real estate with it, because you could always sell the real estate, you could refinance, you could rent it out. There's ways to get the money coming back in. Median asking rent since 1988. Started at $350 a month, and now it's over $1,500. This is nationwide. I keep meaning to make this the background of my computer screen. This year in Oregon, even though we're a rent-controlled state now, we can raise rent 14.6% this year. So if you're like, hey, I don't want to buy right now, like just gonna hang back, rent will continue to go up and up and up and up and up. We are slowly becoming a nation of renters, and that's okay. I've got a lot of houses. I will rent to you and I will raise your rent every year. The average homeowner has 40 times the net worth of the average renter. I believe the average homeowner's net worth is about $260,000. The average renter's net worth is between $5,000 and $6,000. So that is the way that we are able to build wealth in America, is through that, which goes all the way back to the Warren Buffett quote of, I will work until the day I die if I can't figure out how to make money while I sleep. And real estate has been the one thing that actually holds true to that. So when you own a rental, it goes up in value. On average, in the long run, we see a 4 to 6% trend line of real estate value increases over time. We're currently at 3 months of inventory. What that means is if no new houses hit the market, there would be nothing left to buy in 3 months given the current consumption rate. If there was 100 houses for sale and we sold 33 a month and no new ones hit the market, there'd be absolutely nothing left to buy. Americans, we're pretty clever. Whatever law you put in front of us, we're gonna call our accountant, we're gonna call our attorney, and we're gonna figure out a workaround. And for the most part, there's carve-outs and workarounds for almost all of this stuff. One of the biggest carve-outs is if your house is 15 years old or newer, you're not subject to any rent control whatsoever. You can still evict for no cause tenants. You can raise rent as much as you want if your house is 15 years old or newer.